Up to 90% of traders lose money consistently while trading. In this video, I point out 3 main reasons responsible for the losses of the 90% and how to overcome them. So if you want to find out the 3 main factors that account for 90% of traders blowing their accounts and learn how to eliminate them from your trades so as to join the 10% that make money consistently, then keep watching. Before I begin, hit the subscribe button. In that way, you receive any new video I make real fast. The first factor I'm going to talk about is risk management. It is said that the key to risk management is never put yourself in a position where you cannot live to fight another day. There are 6 issues with risk management that leads to 90% of traders losing money consistently. The first factor is inappropriate trade sizing. I know most people aspire to buy that red Ferrari or quit their job that really sucks, or they want to please their spouse who wants to live very comfortable. So people are in a hurry to make money so fast. And so they trade with position size that is bigger than the experience level. And this eventually leads to them taking hits that is more than manageable if the trade doesn't work. And trading as it is, losing is part of the game. So if you are losing and the sizes you are losing is way bigger than your experience level, you're eventually going to blow your account. The key is to understand that trading is not a sprint. Trading is a marathon. Trading takes time. You need to be patient and allow yourself get more experience under your belt so that you can learn how to make the money. Another risk management issue that leads to some traders blowing their account is inexperienced traders. When they win about 3 or 4 times, they feel invincible. They feel like they can do no wrong. They've unlocked the secret code to trading and making tons of money in a very easy way. So they increase their position size thinking now is the time to make money and enjoy. Unfortunately, trading as it is, losing is part of the game. So if the trade does not work as they expect, they end up taking more than manageable hits on their account, and this eventually leads to blowing of their trading account. In my opinion, the best way is to understand that trading takes time and grow gradually. Take your time, have more experience under your belt, and then increase your position size. In that way, you can consider the probability of a trade working out and then the type of setup it is before you risk appropriately. Another factor that leads to some traders blowing their trading accounts is they get fearful when they lose about 3 or 4 trades in a row. What happens is they get hesitant and they also lose confidence in their strategy or their methodology. They feel like it doesn't work anymore and they begin overriding them. Because of that, when their strategy or their setups tells them that they should enter a trade, they wait for more confirmation, and eventually by the time they feel like the trade is going to work and they trigger the buy button, what happens is their risk level will be so high that they eventually end up, if the trade doesn't work as they expect and it turns against them, they end up taking more than unnecessary hits. The way out is to understand that trading, if you lose one trade, there's no any probability that the next trade you're going to lose. You just have to understand that every trade is different, so you take it as such. On the other hand, if you lose consistently, then you have to take a break, maybe an hour or 2 to relax yourself and put everything in the right perspective, and then you can get back to your desk and continue to trade. Another risk management issue that leads to traders losing money is traders dabbling in non-optimal risk reward trades. If you're a swing trader, at least your risk reward ratio should be 1:2. Anything less than that is not optimal, in the sense that anytime the trade goes against you, you're going to lose about 1% of your capital, and if it works in your favor, you're going to get less than 2% of your capital. And trading as it is, you're going to have a lot of hits working against you. So just make sure that when you are trading, you only go for trades where the the setup or the structure is such that you're going to take at least 1:2 risk reward ratio. On the other hand, if you are a scalper, that is an experienced scalper, you are allowed to do whatever because normally they know what they're doing. But scalping is very difficult. It's not for inexperienced traders. And if you have been in the trading space for a while, you probably would have heard about this expression, cut your losses short, let your winners run. In theory, it sounds very good and easy, but in practice, it's very difficult to implement them because anytime you cut your losses short, you end up having a lot of small losses. And mind you, you can bleed to death from 1,000 paper cuts. So if you are always cutting your losses short, you end up with a lot of losses, which can eventually blow your account. Another thing is, if you are cutting your losses short all the time, what will happen is trades that are just not ready to go in the direction you expect, you just cut short. Of course, you can re-enter that trade, but sometimes if you trade, it doesn't go in your direction immediately and it works against you and you exit and then you re-enter. After 3 or 4 times, you give up. And just after giving up, then the trade works as expected. So you end up having losses, whilst other people will just make money out of the same trade that you were just not a bit patient. And so in my opinion, you should have a small trading size so that you can have a bigger risk level, so that you give the trade enough room to maneuver so that eventually it goes in your way. And also another thing to always think about is high probability trades are very essential, because if your trade does not have high probability, then whatever you do is kind of waste of time, because you cannot just dab in trades that are not likely to work and then you use risk management alone to make money. That's not going to work. And the final thing about risk management is that some people don't use is using a stop loss. Some traders just don't use stop loss, and I wonder basically the reason why they don't. The fact that anything can happen in trading means that using stop loss should be a must, because you never know the next news that is coming and the effects that it will have on your trades. And also we have to take a cue from Mark Douglas, who said that when you put on a trade, you should consider it like putting money in a slot machine. It's gone and gone forever. It's never coming back. So only risk what you can afford to lose, and always never forget to use your stop loss. The second factor that leads to traders blowing their trading account is trading without a trading plan. It is said that proper planning and preparation prevents poor performance. And that is very true in trading as well. The only time you should get angry and upset with yourself is when you fail to follow your trading plan and when you fail to show discipline when you are trading. Because these are two things you can really control. The outcome of trades and the direction you cannot really control. It's only probability. But as to following your trading plan and showing discipline to follow your trading plan, it's a must. You must learn how to control them. Otherwise, you end up trading randomly, and that is a recipe for blowing your account. These are some of the things that your trading plan should contain. Your goals. What are your daily goals? What are your weekly goals? Your monthly goals? Your yearly goals? You should always aim to get better than you were yesterday. And so your goals will help you to calibrate your direction. And then your trading plan should include your strategy. Your strategy should at least structure your trade in such a way that you know the risk level you are taking, the probability, and then the targets. All these 3 things should be in your trading strategy. And then there are other factors you want to consider. What do you want to see? How do you classify your trading setups? What are your A setups? What are your B setups? What are your C setups? What do you want to see? All these things should be in your trading strategy. You should know all the things you want to see before you trigger the buy button or sell button. And then there's risk management. So far as anything can happen in trading, risk management is very essential, because the only way you can continue or have a long career as a trader is to make sure that you minimize your losses. And the way to minimize your losses is to make sure that you don't joke with risk management. You should have a very disciplined approach to risk management. Your trading plan should also contain money management strategy. When the trade works in your favor, what are you going to do? Are you going to increase your position size, or are you going to reduce your position size? How many targets will you like to hit before you give up the trade? And then when are you going to move your position to break even? One other thing that should be in your trading plan is the access and time to trade. How long are you going to paper trade the assets before you live trade them? Are you going to trade at the time where that particular asset you are trading has optimal liquidity and volatility? And then journaling and reviewing your trades should be in your trading plan. There is no gainsaying that journaling and reviewing trade is so essential if you want to move your trade to the next level. Because the only way to know whether you are doing something good or bad is to review the trades you do, so that you try to eliminate the things that are not working to advance your trading career, and then concentrate on the things that advance your trading career. So you create a niche for yourself and then try to make as much money as you can. And in trading, you should understand that less is more. You don't have to be all over the place. Just create a niche for yourself where you have the most strength and just concentrate there and make as much as you can. You don't need to be all over the place. And you should have daily improvement targets. What is your aim? Are you going to make sure that at least today I can make about 10% more or 5% more? You should have something. Sometimes it can be having a plan that every day I'm going to read a book about trading, or I'm going to read some books about decision making and try to control myself. All these things helps to improve you as a person and as a trader as well. So the bottom line is, having a trading plan is not just enough. If you have a trading plan and you don't follow it, you're as good as somebody without a trading plan. If you take the time to have a trading plan, then also make sure that you follow your trading plan. And that makes sense. Otherwise, don't waste time having a trading plan. And those who don't trade without a plan eventually leads to blowing of their account. The whole idea of trading plan is to move you from trading randomly to trading routinely, so that you just don't trade anyhow. You only have some particular trades you pick, and when you see them, you trade. Otherwise, you just wait. And as it is said, in trading, doing nothing is trading, because you are saving money if you are not in the market. And the third factor that leads to a lot of traders blowing their trading accounts is having the mindset of wanting to have everything for free. It is said that nothing is for free. Everything has to be paid for. For every profit in one thing, payment is in another thing. So let's put it in the right perspective. When you are trading, you are competing with people from big banks like Goldman Sachs, Deutsche Bank, Bank of America, and all. And out of all these people, retail traders and hedge funds and all this kind of people, only 10% are making money consistently. So if you want to be a trader, you should put your best foot forward. That means you should have deep understanding of the market and how to make money out of it. You should do everything to make sure that you have the best education. Unfortunately, in this time and era where you can find everything for free on YouTube and Google, some people are hesitant to pay money to have education. But unfortunately, as it is said, nothing is for free. You may end up with information from people who just know how to teach how to trade, but they cannot make money trading. So what are they going to teach you? You're going to end up with information that does not work in reality. So you just want to have everything for free. You may end up wasting a lot of time figuring things out. That does not really work. And then there's also the issue of, if you want to have everything for free and you don't have the optimal education, you end up blowing your account a lot of times, and that is cost to you. This same money could have been used to secure the services of a mentor who will help you to shorten your learning curve and get to profitability as fast as possible. So the bottom line is, find the most cost-effective means to have deep understanding of how the market works and how to make money out of it. In my honest opinion, it will be easier for you to follow a successful mentor than try to figure everything out on your own. Now it's your turn. In your opinion, what is the one main cause of the high failure rate in the trading space? Is there any other topic you would like me to talk about next? Leave a comment below. I want to hear from you. Have you gained any value from this recording? Please consider subscribing. Smash the like button and share with your friends so that you become among the first to receive any new recording I make. It really supports us. Thank you for your time.